Good afternoon or good morning, ladies and gentlemen, depending on where you are. My name is Gabriel Stein. I am Director of Asset Management Services for Oxford Economics, and I am delighted to welcome you to this webinar where our Managing Director for Macro Forecasting, Scott Livermore, is going to talk us through the Oxford Economics Global Economic Outlook predictions for 2015. If I may just possibly mention one or two housekeeping rules, please keep your buttons on mute because there's quite a few of us listening in. And if you have any questions, if you can please send them to Adriana Kachaturian, whose email will appear on your invites. Or by pressing, if you're using a computer instead of a phone, by pressing the chat button, which is on top right of your screen. Without any further ado, let me pass over to Scott, who will, as I said, tell us what Oxford Economics thinks is going to happen this year. Over to you, Scott.
Okay. Thank you very much, Gabriel. And I'd also like to welcome everyone to joining the webinar and wish you all a Happy New Year to start off with. Many of us like to make New Year's resolutions at the beginning of the year, and we stick to those with varying degrees of success. But as economists, we like to make predictions for the year ahead, also admittedly with a varying degree of success. But I think our track record from last year proved or showed at least that some of our calls come true with a fair degree of accuracy. And what I'll do over the next minutes or so, and then allow you time for question and after, as Gabriel said, is somehow shoehorn into this presentation our top 10 predictions for the year ahead, and set it in the context of our forecast outlook, which the latest forecast outlook we're due to release today. But before we go too forward-looking, let's start off with where we ended last year. And towards the back end of 2014, some of the data coming through were less positive, and there was spreading concern about the outlook. A couple of charts here just illustrate that. On the left-hand side, you have the Purchasing Managers Index for manufacturing, and with the notable exception of the US, you can see that the US-China saw activity easing towards the end of the year. And if I added any number of countries, you'd get a similar picture to that one shown there. And what was particularly worrying about the end of last year was the trade side. On the right-hand side is our composite trade indicator, which brings together orders, export data, surveys for the main exporters out there, so US, Germany, China. And in the second half last year, that was very weak, which was contributing to the overall concern about the global outlook. And prime behind the concern was the development in China. And as we all have a healthy degree of suspicion around official statistics, I've included a chart here which looks at GDP as well as and comparing that to the alternative indicator that Oxford's constructed, which brings together probably harder, easier to observe indicators such as electricity output, rail freight, credit, to give an indication of the trend in the Chinese economy. And this chart clearly shows that China was slowing quite rapidly towards the end of 2014, and helps explain some of the monetary policy measures we've seen, such as the cut of interest rates. And Q4 data are due to be released in the next few days, and by right, these data should show a significant slowdown. I suspect the official data will still lead with a 7, but only just. One of the consequences, and there's many factors going into this chart, but one of the consequences of slower global growth, and particularly in China, is a sharp drop in oil prices. So oil prices have been on the slide now for a good 6 months, falling from over 110 to the 40s in recent days. with this rate of decline accelerating in the past couple of months. There's a few questions around what's causing this decline in oil prices, and like most economic developments, there's the mixture of factors. But if we want to characterize what episode this drop in oil prices is like, we'd probably say it's closer to the 85-86 example, when there was a good degree of supply influence and supply was relatively strong, and in the current time, this boost to supply from shale and re-emerging markets such as Iran and Libya have kind of extenuated the weaker demand outlook, compared to the situation in 2009 when oil prices plummeted, which was clearly very much a demand-driven as the global economy collapsed post the financial crisis. So in a supply-driven slowdown, even if it's on the background of weaker demand, there should be a boost to global economy. And for ease of viewing, I've summarized this into a few big blocks. You can see that the impact of a $20 reduction in the oil price and the impact on growth. Clearly, we've had a much bigger impact over the last 6 or 7 months, but $20 is not unreasonable to see what we'd be expecting our forecast to change over the last couple of months, and reflecting the more recent change in the oil price. And you can see at a global level, Eurozone, we'd be expecting the level of GDP to increase by 0.2%, 0.3%, 0.4% over the next couple of years. And clearly offsetting that is the slowdown in OPEC countries. Many OPEC and other oil producers have a vast degree of wealth which they can draw on to support and smooth the adjustment, particularly from the fiscal side, to the slowdown in oil prices. But the oil price slump is going to bite a lot harder in other countries, and those that would spring to mind are probably Venezuela and Russia. But overall, Oxford Economics standpoint, and you may have seen it in some of the material being publishing both as part of our global macro service and in the press, is the drop in oil prices is good for oil-consuming countries, even though there are concerns about the level of inflation and deflation. And you could argue that, to a degree, this is actually starting to come through. This chart shows the Citigroup's Economic Surprise Index. So it really tracks whether a data release is above or below expectation. It doesn't really say whether it's strong or weak per se, but it shows where it comes in relative to market expectations. The US has been strong for a long time, well, for most of the second half of 2014, and surprising on the upside, whereas through most of 2014, the G10 as a whole were generally surprising on the downside, and that just really reflected the direction of travel or forecast in the past 6 months. But at the turn of the year, it seems that the data being released have generally surprised on the upside and should lift some of the gloom. As I say, this is not exactly, it's not an indicator to show that growth will be picking up or booming. It just shows that on the whole, the current activity levels are slightly better than most commentators, most monthly forecasters had been expecting. So they're really talking about the oil market and the oil prices, which is really the key factor that's affecting the global economy at the moment, brings me on to Oxford Economics' first prediction of the year, and that will be that oil prices are expected to remain weak going forward. Putting a precise number on that is difficult, given the volatility and the likely market moves, but on the whole, we expect oil prices to remain near or just above current levels going through 2015, 2016. This clearly reflects predominantly a supply issue. We've followed the discussions about OPEC and Saudi in particular, whether they're going to cut production in order to support prices, and it seems that that's unlikely. Rumours in the press that Saudi won't cut production even if oil drops to $20 a barrel. US shale clearly is a play here, and the lower the oil price falls, the less profitable many shale wells and shale production becomes. But if we looked at the latest EIA, so the American Energy Institute's forecast for shale production over next year, that still suggests that shale production, or US oil production as a whole, is going to grow, and set that against continually modest demand growth, then the supply and demand gap and the accumulation of stocks could actually increase going forward, keeping oil prices at the current low levels. Much of the focus through 2014 was on central bank world, really about Fed tapering and the termination of asset purchases, which have now come to the end. And clearly that removes one of the extra monetary stimuluses that have been in the global economy over the last couple of years. But the consequence of the drop in oil prices and the inflationary impact associated with low oil prices really does allow those central banks and economies that appear to be recovering to err on the side of allowing growth to bloom and continue to pick up. We expect the Fed only to start raising rates in June at the earliest, and if growth continues, if growth is weaker than they expect, or the labour market doesn't carry on to pick up, then that could be pushed back further. And in the UK, we don't expect the Bank of England to move in 2015 at all, and really continue to allow the growth forecast. And the rise of deflation fears, will this negative inflation turn into a deflationary spiral, will really see other central banks stepping in to fill the stimulus gap. We've seen the ECB plans to increase its balance sheet by up to $1 trillion over the next year. We expect it's highly likely that $500 billion of new purchases will be announced at the next meeting. It's still uncertain whether that will continue to be the asset-backed securities that they've purchased today, or broaden into sovereign purchases. But I think it's clear that the ECB will be much more active going forward. And similarly, we've seen that the Bank of Japan has already announced that it's stepping up its purchase program, which will amount to about 15% of GDP this year. And then overall, that means our second prediction, that in 2015, at an aggregate level, we're likely to see more supportive central bank policy than we did in 2014, especially when you throw into the mix that the Chinese central bank is likely to join in with possible further interest rate cuts and cuts to reserve requirements. Supportive monetary policy, lower oil prices, also lead into our third prediction, which is a US consumer upturn. It's been relatively lackluster, the US consumer, over the last couple of years, stuck at a growth rate of around 2%. But we can see on the right-hand side of this chart already the impact of lower oil prices feeding through to sentiment. The pace of jobs growth in the US has been around 250,000 per month over the past year. And there are some tentative signs that wage growth is picking up, and we expect it to amount to about 3% over the next year. And combined with inflation sliding below 1%, that is a significant boost in household income. And then we should see an acceleration in consumer spending in the US. And the US should achieve 3% growth somewhat comfortably for 2015. And that is the first 3% growth seen in the US in a decade. So it really is a significant pickup. The continuation, the strength of the US and really moving out of the 2% orbit also contributes to our fourth prediction that the US dollar will continue to rally. In trade-weighted terms, the dollar is up about 8% since mid-2014, and a lot of this has been driven by different directions of monetary policy. We spoke a little bit already about the activities of the ECB and the Bank of Japan in becoming more active, while the US has been tapering. This is summarized in the US 2-year bond yield, and whereas that's edging up, and equivalent interest rates in the Eurozone and Japan will be going in the opposite direction. And that's been the story to date. And these trends are expected to continue going forward. So the relative policy stances are one, where the Fed is at best keeping the same, potentially starting to tighten, where the ECB and the Bank of Japan will continue to expand. And we expect a further 5, 6, 7% appreciation in the US dollar over the next year, with a lot of this strength coming against its main competitor economies. So in terms of exports, the US really competes against the Eurozone, predominantly Germany and Japan, in producing things like machine tools, cars, and those high value-added manufacturing goods. And by the end of this year, we expect the euro dollar to be down to around $1.15 per euro, and the dollar yen to be around 1 yen 25 per dollar. So a significant further strengthening of the dollar in track. In many ways, prediction 5 could be considered one of our bravest, given the ability of the Eurozone economy to continue to disappoint. But we think there are solid reasons for Eurozone growth to surprise on the upside. And why are so surprise on the upside? Exceed consensus. Our forecast for the outlook for the Eurozone is comfortably above consensus, and developments over the last couple of months actually make us feel stronger and more confident in that call. So what we have going on within the Eurozone that helps with this confidence is, I say, the counterpart to dollar strength is euro weakness. So a weakening euro will boost exports from the Eurozone. We've seen that the ECB is becoming increasingly engaged and increasingly active, and their policy is going to continue to bear fruit. And even some of the policies to date have seemed to have gone some way to start repairing the banking sector, and we see lending conditions easing, we see money supply growth picking up, all good signs that the banking sector is ready to start contributing to economic growth in the Eurozone. There's been a subtle but discernible change in the European Commission's attitude to the fiscal position. They are much more focused on structural deficits rather than headline deficits, and overall this is likely to mean that fiscal policy in the Eurozone is likely to be broadly neutral rather than the drag it has been in recent years. And these positive backdrops should allow the consumer to benefit from the falling oil prices, rather than worry about a deflation spiral that some commentators may be fearing. Really, in the Eurozone, we have falling prices in one or two key sectors, but the broader price index and domestically driven prices still continue to grow upwards. But overall, the negative inflation, even modest wage increases, should lead to improving household income, as we see in the right-hand chart. And also, there seems to be an uptick in jobs growth in the Eurozone. 800,000 new jobs were created in Q3, the strongest in 6 years, and this should translate into a gradually strengthening domestic sector, which will lead to Eurozone growth expanding and accelerating on 2014 and surprising many commentators. it's been long our position that Greece, the Eurozone, remains intact. Over Christmas and the New Year, there's been increasing concerns about Greece, predominantly due to the election that's been announced for the 25th of January, where the Syriza party looks like it's going to be the lead in the government, if not solely forming it. And typically this party has been quite anti-austerity, been making quite extreme statements about debt support, which at the face level wouldn't be acceptable to European partners. And that's led to an increased concern, and you can see that slightly on the right-hand chart where the spread on Greek government bonds has ticked up. A few things to note. As I say, we don't expect Greece to leave the Eurozone. We think there's an element of a game of brinkmanship, but ultimately compromise will be reached. We see that the leader Syriza already being more conciliatory now. He looks like he's going to be in government than when he was clearly in opposition, and it's likely that the Eurozone authorities also move to help Greece to ease some of the austerity. Where we have more concerns continue to be emerging markets. I mentioned at the start that growth in the Eurozone, in China, is likely, has been slowing quite sharply into the second half of the year. I think it's likely to continue to slow in 2015-16. Our forecast for the coming year is definitely for growth to be below 7%. And there's two main worries and significant short-term adjustments, which are arguments that have been well made in the past, so I'll just recap them here relatively quickly. There's overcapacity in the real estate sector. It would take about 4 years to sell the property currently under construction at the current pace of sales, and investment continues to grow in the sector. And China has a rapidly escalating debt problem, with debt expected to reach about 265% of GDP, predominantly in the corporate sector, but it's fast becoming a level that is unsustainable if it's not reached it already. And that adjustment is likely to lead to more pronounced slowdown over the next couple of years. And over the longer term, so the medium to longer term, we really have to get used to slower growth in China, and around 5% will quickly become the norm as there's a slow degree of capital accumulation, population dynamics become disadvantageous and contractionary growth, and a degree of catch-up through things like R&D, shifting from agriculture to manufacturing sector, education development, mean that the contribution from total factor productivity, so the effectiveness that labour and capital can be combined to produce, is also likely to subside going forward. And we're also a little bit concerned about Asia more broadly. The theme in recent years has really been the rise of the Asian consumer, but since 2011 there's been a quite significant slowdown in consumption. So excluding Japan, consumption growth slowed from about 7% to 5.5% between 2011 and 2014. In part this reflects China, and we've covered that elsewhere, but it also reflects debt levels across the Asian economy, which have risen quite significantly. So if you look at Australia, Singapore, Taiwan, Malaysia, Hong Kong, Korea and Thailand, debt is currently above 100% of disposable income. You've also seen quite a ramp up in house prices, and this adjustment and the adjustment to the rise in debt is likely to weigh on consumption going forward. In the very short term, this will be partly offset by a fall in oil prices. A number of the emergers are big net oil importers, and energy consumption is an important share of the overall consumer basket. But the trend and the implication of the debt can maybe dampened and delayed, but not completely offset by the decline in oil prices. And prediction 9, focusing on the emerging markets. We've written on this quite extensively over the last 3 months. We consider a default in the Ukraine almost inevitable. The flight of currency, and which is reflected by the rapid weakening in Ukrainian currency, shows the mistrust and worries around holding Ukrainian debt. And the chart on the right-hand side indicates the degree of stress perceived by international investors, with the Ukrainian spread over US Treasuries only exceeded by Venezuela, with Ukraine comfortably exceeding for Belarus, Argentina, Belize, Pakistan, and we expect a default, be it restructuring or reprofiling, but significant activity and significant write-downs in Ukrainian debt going forward. Clearly, this will have a significant impact on the economy, on top of the fiscal adjustments being imposed by the IMF, and we expect GDP to contract by some 8% this year. The other partner in the crisis, or partner is probably the wrong word in here, but the adversary in the crisis, Russia, we think a default is unlikely. Its external financial position is much stronger than it has been in the past. But nevertheless, we expect the Russia economy to see a similar kind of decline to the decline seen during the global financial crisis, where peak-to-trough GDP dropped by about 10%, and that really is increasingly a function of the oil price. The Russian break-even oil price is well above $100 a barrel, and current oil prices call for some serious adjustments in the Russian economy. I've cheated a little on prediction 10 by calling them wildcards, so I won't go into them in particular detail, but these are a few predictions that aren't our central forecast, but things that we would not be surprised if happened and therefore considered wildcards. We can look for a mini debt crisis in Latin America, and Venezuela is really the worry child there. Every point I just made about Russia really applies with significant degree to Venezuela in the face of the declining oil price. Russia could emerge as the new Iran, somehow shut off from the West, operating in parallel, but really that kind of environment suggests that Russia would be very unlikely to recover from the sharp falls in GDP that we're expecting over the next year. The US growth surges to 4%. I think as an economist you often admit that you're sometimes a little bit too cautious on predicting the upside, so that in itself suggests there's upside potential for the US forecast. But clearly there are many conditions in the US which suggest the economy should be primed for liftoff. And I think we would argue that the key factor to driving this would be wage growth and household income picking up faster than expected, that creating a positive domestic demand confidence spiral that really does lift the US economy stronger, and stronger enough to offset the inevitable rise in the US dollar that would come from the US outperforming expectations. And the final wild card would be that China pauses on the rebalance of its economy towards being more domestically focused, and in the face of slowdown and a reluctance to boost growth by expanding credit expansion, that it looks to boost its economy by depreciating the renminbi and trying to generate some export-led growth. This would be a deflationary shock for the rest of the world and really obviously have some negative repercussions for Asia as a whole. So I've just run through the top 10 predictions for 2015. So where does that leave us, and where does our forecast compare to last month when we previously gave the global outlook update? I think you can see across the board we've made upgrades to our growth forecast for 2015, in contrast to some of the news around, say, the World Bank's release. We're becoming increasingly optimistic and positive about the potential for growth in 2015. Clearly, the world figure is also weighed down by some developments in oil countries. But we're looking for the UK, US to achieve growth of 3% plus this year. Eurozone could rise to 1.5% in 2015. And while China continues to slide, we think the authorities will continue to manage that slide, which is a difficult job, and the slowdown will be gradual, but we will have to get used to growth over the next couple of years being 6 something rather than the headier growth rates we've seen over the past couple of years. I've probably spoken longer than I intended, or should have, so with that I'll open up to questions, which I assume Gabriel will feed through to me.
Thank you very much, Scott. Yes, that was extremely interesting, and I'd actually heard much of this, and I still found it interesting. We have had some questions coming in. You will not be surprised to hear that they relate to oil. The first question is, what's the reason for the delay in the impact of falling oil prices on the economy? And I think the point is oil prices, after all, began to tumble last summer, but it's taking some time to materialize in substantial visible improvement.
Cool. And as I alluded to as I went through the presentation, that the economy is very, and the determinants of growth are really quite a mixed bag. So there's many things going on which interact quite extensively. And I think increasingly, well, at the beginning of the fall in commodity prices, then certainly my perception was that this was predominantly demand-driven, and it's reflected in part to a slowdown in China, and I think we saw the Ukraine and Russia crisis weighing on European confidence, and we had a situation where, falling oil prices on the one hand is a positive, but at the same time there are other factors that are working against this, and there was, if you like, a broad offset. I think in more recent times, centered on discussions around OPEC, maybe a better understanding of what's happening with US shale, that we can't ascribe all the fall in oil prices, and certainly not the latest tranche in the downward fall in oil prices, to demand factors. So the real supply side shock and the drop that's likely to boost the economy is, I would argue, probably really started to crank up and take hold towards the end of the year. And I think that's probably consistent with some of the indicators I've shown through this presentation that have suggested that some of the benefits are starting to feed through now, and we expect that to accumulate during the first half of this year.
Okay, well, following on from that, and there's been a few more questions about oil, so there'll be quite a few coming, but one question that has come in is everybody else seems to be in a real panic about deflation. The Bank of England is postponing its rate hike until 2016. The European Central Bank is throwing everything it can to avert deflation. Japan, of course, as we know, yet Oxford Economics seems remarkably calm about lower prices. Do you want to comment on that, perhaps?
I think people should be scared of deflation, and if deflation took hold, that would be bad. Our view is that we're in a period of negative inflation, and the big driver is a shift in relative prices. And why we're in that phase that benefits households, lowers cost of business, all those kind of things that should lead to a demand boost. And what's critical, and I think you see it with some of the commentary around the central banks that you've mentioned, is that the central bank should use that as an opportunity to make sure it doesn't slide into deflation and provide further stimulus. So the ECB would be exactly right to take it as an opportunity to boost its contribution. The Bank of England's right to hold off increasing interest rates in order to allow the economy to continue to grow. And the key thing in this world to make negative inflation be a positive and not to turn into deflation is to generate the environment for growth to pick up. And hopefully, and I say some of the comments we've seen, central banks are standing ready to do that.
Okay, we have. Let me take another question that has come in, which does not have to do specifically with oil. It is to do. Well, don't worry. There's plenty more, Scott. This has to do with Greece. So Oxford Economics has put out a piece by Gabe Stern, highlighting the very high likelihood that Syriza may be able to form a government on its own in Greece following the 25th January elections. And their policies are, to say the least, inimical to what their European partners want. And yet the Oxford Economics forecast is Greece will remain in the Eurozone. Does that mean that you expect Syriza to cave in and once they're in government to suddenly grow up and be more serious or suicidal, depending on one's point of view?
Was that your add to the question, or?
That was indeed my add to the question.
I thought it may have been. I think there's been a long track record through democracies around the world where parties of opposition change their tune and move their position once they become a party of government. So I would certainly expect a Syrian government to be less reactionary, less confrontational, and I think you've seen that in their recent policy statements as other parties in Greece have attempted to make this about an election about being in or out of the euro, and most Greeks still want to be part of the Eurozone. I think it's likely you see movement on both sides. Clearly, Greece is in a primary surplus. Let's say it has a stronger negotiation position. And back in 2011, the Eurozone authorities said they would look at further concessions once Greece has got into that position. Where the swingometer actually ends, whether it's mostly Syria caving in to the Eurozone's austerity package and getting few but superficial concessions, or whether it's the rest of the Eurozone allowing more time and accepting Greece and its policies to support the economy, is hard to say. But I think what's clear, and even though a Greek exit wouldn't have the fear factor or as severe damaging ramifications as it would when the crisis first took hold a few years ago, I don't think it's in anyone's interest for Greece to leave the Eurozone. Greece may, in the long term, would be disadvantaged from leaving, and if one country leaves the Eurozone, even though there may not be the wildfire financial contagion spread, it removes the myth that Eurozone membership is irrevocable, and next time a country does get in trouble, then it's likely to face very, very, very severe challenges and escalation challenges, and the drug you put of doing what it takes to keep things together won't carry as much weight.
Okay. One question that just came in. What are, and I think to some extent that's the wild cards, but what are the main downside scenarios or black swans in the next year or two?
The thing I'd be most worried from a global perspective would be China growing at 4 to 5%, not 6 to 7%. China has the means to manage the debt crisis, and over the years it's proved remarkably able to manage the massive economy that it is. But clearly, if any cogs in the broader public system between central government, local government, state-controlled banks and state-owned enterprises seizes up, then the size of the sums we're talking about could lead to quite serious repercussions. And I'd probably add to that I think it's probably easier to manage an economy when you want to maximize growth. It doesn't really matter if it comes in at 8 or 9% and you're throwing resources at it. But what I think the authorities are doing is trying to manage a slowdown, which is a much harder job to do. If you could risk not doing enough and growth plummets and it's hard to catch once it's out of control, or you do too much and the problems that we highlight about the level of debt and excesses in the property market expand again, and that bubble reflates and it just really kicks the can down the road and creates a greater risk of crisis in a year or two's time.
Okay, we have one or two really technical questions that have come in, and I know you're capable of answering them. If it were me, I'd be much more frightened. But I want to finish, sort of allow you to round up with another question first, and then we'll move to the technical ones because they are much more model related. And this is someone who says, okay, so I've listened to this and it's fascinating and very interesting, but what does this mean for my asset allocation? Where should I go, to paraphrase the question?
Well, there's a question and a half, and arguably, Gabriel, you may be slightly better positioned to answer that one than myself. If you want to have a first crack.
Well, the problem I find is, I'm happy to give it a go, but the problem I find looking at the world is that everything that you've said so far and all our views so far would indicate that equities should be more attractive than bonds. Some central banks remain stimulatory, others others are moving to tighten. But given where fixed income is today, it's difficult to see it improve unless you were to have massive deflation in the Eurozone. Commodity prices coming down further. And so really it should be equities. And the concern there is, of course, that equities are already highly valued by some standards. But nevertheless, by default, it seems to me, the most attractive assets are equities. And within equities, I would say, I would have said US equities until recently. I think probably today Eurozone equities look somewhat more attractive. But on the other hand, it's still a dollar strength. So it's really a toss-up between those two. Can I move on to a... Actually, gosh, one more question has just come in here, and then I'll take it to the technical one. Question is, can the ECB and the Bank of Japan's respective quantitative easings be successful if the Fed is not? Now, there's an interesting one, because there are a lot of assumptions in that question for you. Well,
I suppose I should start with a premise which may be disagreeing what's implicit in the question. But I would argue that the Fed's QE has been successful in certainly lifting the US and keeping the US out of the kind of economic performance that we've seen in the Eurozone and Japan. So I wouldn't look at the actions by ECB and the Bank of Japan through the negatives of Fed failure. I think there's lots of reasons to argue that quantitative easing, and particularly purchase of sovereign debt, is likely to be less effective in the Eurozone and Japan at this current point in time than compared to when the Fed has been doing it, given the already low level of bond yields, given that corporates get a lot of their financing in the Eurozone from the banks rather than corporate debt market, given equities aren't particularly undervalued in the Eurozone, and a lot of the traditional channels wouldn't be at play. And I suppose there's the added factor that if it is a currency war, and both Japan and the ECB are expanding QE, then it may do lots against the dollar, but I think Germans are probably more worried about Japanese manufacturers in the competitive marketplace. So some of the competitive gains wouldn't come through because both trading blocks are doing the same. So there's reasons to say it could be smaller. I think what both economies need is really a boost of policy that leads to increased demand, and really I would argue, particularly in the Eurozone, less so in Japan, that a policy of monetary expansion on its own will not be as effective as one where monetary authorities and governments are working in coordination to think about ways of actually increasing demand and how much of that monetary expansion is translated into spending within the region. And I think there's risks that QE could turn into a little bit of a damp squib if we don't have that kind of coordinated action.
I think that's probably right, and I think the only thing I would add is possibly the question also is about, after all, the Fed didn't manage to create inflation, and will the ECB and the Bank of Japan do so through their QE, and perhaps not. But let me move to the last question, and you know, Scott, we have a bit more than 5 minutes left, and then, as you know, we get booted out by WebEx. So that puts a bit of a constraint on you. But the question is complex, and we may have to get back directly to the questioner. So the oil equation for Japan is very odd. It massively mutes the impact from Brent 50% drop to a 10% decline in domestic oil prices before the carbon tax. So your Japan GDP jump in 2015 is very small, as consumers do not see any drop in oil prices. Why is your model built in this manner?
Well, clearly we'll have to get back to them with the specifics. I don't have the Japanese equation in mind. But several things to throw in there to keep in mind when translating a drop in Brent crude to domestic energy prices. Firstly, we don't consume crude, so we need to factor in some labour costs and other production costs in order to generate the petroleum, gasoline and other derivatives that we do actually consume. And clearly that's only a relatively small proportion of the total cost of, say, petrol at the pumps or gasoline at the pumps, but that is a factor to dampen it down. The other main factor is most developed countries, shall I say, will have a regime of excise duties that apply to energy prices, and these tend to be specific, and depending on that level, that will affect the pass-through of a percentage change in the crude price to the petrol pump price. So, for example, if there happened to be a excise duty that is half of the petrol pump price, and that excise duty is specific, then the variable part of the oil, the petrol price, is only 50% of what we pay at the pump. And the model is designed to reflect those features, so it's not just a matter of saying Brent crude dropped by nearly to nearly a third of what it was, so therefore petrol pump prices should, but it explains, and the model should reflect those factors. I'm afraid at this time I can't comment on the specifics, and if we can take the details of the person that asked the question, we can get our Japanese economists to reach out to him and deal with the specific coefficients that's being referred to.
I understand. I think that's probably the right way to go about it. Ladies and gentlemen, we have come to the end of this webinar. Thank you very much for taking your time to listen in. If you have any further questions, please send them, again, you can still do it via the chat button, to Adrienne Kachaturian, and we will reply to them. Thank you very much, Scott, for your presentation.
Pleasure.
And ladies and gentlemen, we have webinars every week. You will be apprised of them 1 or 2 weeks ahead of time with a topic, and we look forward to inviting you to our next week's webinar, which will have Gabriel Stern talking about Greece. Thank you very much, and I hope you have a pleasant continued day wherever you are.